I just wanted to follow up on a asset allocation update from a few weeks ago, where we see the opportunities currently in the market, particularly with where interest rates are going and weak investor sentiment. We think it's possibly an overlooked part of the market. So starting at the top, over the past 12 months, as we all know, we've seen one of the fastest and steepest tightening cycles since 1994. And this type of tightening in such a short space of time doesn't come without risk. And we've seen, obviously, over in the UK bond market late last year and the issues there. We've also seen that play out in US regional banks. So they're unlikely to be the last problems we see in the global financial system. So we are in a period of heightened uncertainty, both politically and economically. As you can see on the chart on your right-hand side, it gives you a sense of the amount of uncertainty we've seen over the past few decades. And you can see there we are in a period where, rising interest rates, we had COVID, a series of rising concerns around the global financial system. But the good news is, I guess, we are near the inflection point when it comes to interest rates. So most central banks are at or near the turning point for interest rates. And typically when we see the last interest rate, we can interest rate rise in the cycle, typically see risk assets rally on the back of that. And the chart on your right-hand side gives you an idea. Once the last rate hike hits, typically the S&P 500 rallies. So 5 of the 6 previous cycles, we've seen a meaningful rally in risk assets. So we are nearing that inflection point, as Richard sort of pointed out in his introduction. So this morning, I just wanted to cover off an area or an asset class we think offers decent risk-adjusted returns. If, in fact, we are nearing the inflection point for interest rates, and particularly if the economic downturn here in Australia is more mild than perhaps what the market is currently pricing in. So we think it's worth revisiting small caps. It's been a horror run for small caps over the past 18 months since we've been in this period of rising interest rates and rising inflation. So after rising strongly post-COVID, the small industrials over the past 18 months is now down 11% versus the ASX large industrials. Now, if we were to bring that back even further, looking over the past 22 years, you can see there the chart on your right-hand side. It's a relative performance of the large industrials versus the small industrials. So small industrials underperforming if it's much lower as part of the index. So you can see there, we are back to sort of 2015, 2016 lows. So it's been a significant period of underperformance of small caps. Now, we're not saying, it can't get any worse from here, but we do think there are reasons why we think small caps perhaps may see a bit of interest in the near term and perhaps close some of that underperformance to the large cap industrials. So firstly, on fundamentals, we are looking at a much better picture when it comes to fundamentals for small cap industrials. If you look at the median ROE and the median leverage, the gearing level, net debt to EBITDA, you can see that's improved over the last few years. That significantly worsened into COVID and even the period during COVID, but that has since reverted. ROEs have ticked up, but also gearing levels have actually come down quite sharply as well. So fundamentals are actually looking in much better shape. Small companies obviously focus on balance sheet, focus on returns, so that in our view is a good thing. Secondly, sentiment is starting to turn around. So over the past 12 months, we've seen a significant reduction in short interest, particularly in some of those, former market darlings in the small industrial space. If you look at the likes of Nanosonics, Polynovo, Kogan, Telix, Hub, Pro Medicus, Pinnacle, just to name a few, we've seen significant shorts getting covered amongst some of these names. So it's a good signal that perhaps some of the sentiment, that negative sentiment, is turning around to some of these small cap industrials. It's not to say that's happening across the board, but certainly a lot of these, former market darlings across the small cap industrials are seeing significant amount of short covering. We also note last month, the $200 billion future fund doing a U-turn on its strategy. Typically over the past 6 years, the strategy has been to buy the index-hugging strategies, so low-cost index-hugging strategies. They're taking a turn now where interest rates and where they think the opportunities are, and they have commenced a new program to invest in domestic small caps. They see active management as being a point of difference for returns moving forward, given the current economic climate. And thirdly, look, it's all about growth. It's still part of the market offering decent growth. Now, despite a fairly meaningful deterioration in earnings forecasts over the 12-18 months since the onset of higher rates, consensus is still tipping solid earnings growth for most small industrials. Now, this chart here gives you an idea of the proportion of growth that we're expecting amongst the small cap industrials, and you can see that the proportion of companies expecting 20+% growth is around decade highs. So, still a large cohort of companies expecting reasonable or very solid, in fact, earnings growth over the next sort of 12 months. So we think there are plenty of reasons to revisit small cap, but we do think it is an opportunity to look at, particularly as we get closer and closer to the inflection point of interest rates. And in fact, the performance would suggest that perhaps some of these small cap industrials may start to close the gap among some of the large cap industrials. But we do think fundamentals, as we pointed out, many times this year, is going to play an increasingly larger role this year. It's not so much going to be a macro market, but more a market that's going to be fundamentally driven. And when we look at valuations across the small caps, it's not screaming cheap at the moment. It's still trading at above sort of long run averages. But you can see there what's happening in amongst the small cap industrials, that dispersion between high PE and low PE stocks. It's quite a wide dispersion. So again, when it comes to stock selection, it's quite important when we're looking at the small cap segment of the market. A blanket, passive exposure is probably not going to cut it, just given the divergences at play within sort of the small cap universe.